first video in a little while. We had a bug in the house, and when you're feeling rough, you're not really keen on spending too much time doing this sort of thing. So it's all past now, hopefully, and I have already looked at this here site center Corp. Got up on the screen in front of me. It's a no from me, but I'll quickly run through why it's no. I have done a little bit of analysis on this, but it's just not cheap enough for me. I am just off screen a minute, trying to find my tracker notes. Let's find it down here. Look, site centers. Here we go. So they own and lease, it's REIT effectively that leases developed shopping centres, primarily open air shopping centres anchored by grocery and necessity based retailers. I think it's high end, meant supposedly high end stuff. 33 shopping centres, including 11 joint ventures. One fund, Gumshoe Capital, owns 13.49% of has 13.49% of the portfolio, which is quite high. You know, I normally like to see numbers like that. Nobody else owns more than like anywhere near that. It's just a one-off fund doing it. No insider buy-in for a long time. As you can see by the price that there's probably a reason for that. They ain't done very well for a spike up here in 2020, end of 2024. I'm not actually sure what's caused this spike, because that's huge, but also split. That's what happened there, and it's just come down ever since. And my quick reasons to say no, kind of book value 624, currently around about 615, I think. So there's no downside protection from assets. Obviously, I don't know what you would get in liquidation for this as well, because obviously you are in a very niche market. You got to fight. If you're fire selling a shopping centre, then you're probably not going to get the asset value for it, I would imagine. Grok reckon that you'd only maybe get 200 to 300 million. Which is nothing. Revenues have shrank massively as well, but they have had a spin-off. It got rid of Curbline Properties, convenience retail portfolio, so probably a reason why. The only problem is there's no real way of finding out what normalized earnings is at the moment, because they've sold off so much stuff. They've got no debt. There's zero debt now, I believe. So, you know, the balance sheet is pretty good, but there's no downside protection from the balance sheet. You're still around about, you know, the price. But then, like I said, if you liquidate, then you're probably not. Net cash is way above current price as well. But there's been 770 million sales of assets, TTM, with over 3 billion the previous 2 years. So they've been really cutting back on probably non-performing assets and all that, which is obviously a good thing. Cutting back and trying to save up the balance sheet, which is good. It does look pretty good, but it's just, I don't know, like for me, there was just not enough in it. There's not enough downside protection from the assets, and it's quite difficult to tell what the earnings of it is, because you can't get a very accurate net operating income because of all the asset sales and all that. Simple free cash flow heavily skewed as well, because in the investing section, they're just year after year after year, they've been selling large portions of property. So for me, it was just a quick pass, because at the moment there's a lot of restructuring going on, and from the time that I could be bothered to spend on it, I couldn't find a reason to invest, because I couldn't be bothered to spend the time. That probably sounds quite bad actually, that I couldn't be bothered to spend the time, but there was nothing in it that I could see where if I spent the time looking at the earnings, I'd find anything, you know, and there was nobody else seemed interested in it either. They themselves are not interested in it. Or I may just yawning. So yeah, I quickly moved on, but balance sheet now is pretty damn good. Get it up here. I say the balance sheet is pretty good. Property here, 555 million, half a billion in property, less depreciation, 119 in cash. Down here, no debt. Amounts payable to Curbline, which I believe is a joint venture, possibly. So total liabilities of only 83. So, like I said, the balance sheet is pretty good, but the income terrible. Yeah, not something that I'm interested in currently. But if it continues to fall off a cliff, then yeah, maybe. I mean, if we could get down to previous lows, then I might start being interested in it. We'll see. We keep an eye on it. It's not something that I'm hugely enamored with. Hardly anybody spoke about it on. Last one was a sell in June 2025, which obviously, when we look in June 2025, was a very good call. You've lost almost 50% of your value since then. Sorry, I keep bloody yawning. So yeah, it was an easy pass for me. For now, doesn't mean that it can't get cheap enough. Like I said, the balance sheet's pretty good, but we'll see. I had moved on to OSPN. I was just having a quick look at the balance sheet. I was figuring out what the company does. OneSpan, sales cybersecurity. Where is it? Down here somewhere. So I did top ships recently. Why have I said no to this fund? Because it's a fund. Multimedia Trust close-end fund, so no, I said no to that. I said no to that because it's a fund. TDF fund, said no. Glow fund, said no. So here we are now at OneSpan. It'd be nice if I could drop these funds out, to be honest, but I don't know if there's the ability on the screen to do it. Anyway, yeah, so here we are now. This is where I am currently at. Looking at OneSpan to see what OneSpan is, how it makes money, see what the balance sheet is like. I've started I say new, it's not new, but I've got this here, which I've stuck to the back screen. Logical steps for speed. I want a base understanding of the business and what the business does and how it makes money. And then, is there downside protection? 30 to 50% minimum below conservative intrinsic value, tangible assets minus total liabilities, liquidation or reproduction value depending on the business type, or from the earnings, high earnings / free cash flow multiple, high earnings / free cash flow yield / low multiples. Can this investment pay me back within 3 years? So that's like a Monish Pabrai thing I'm looking at there. Monish Pabrai said that he would only invest in stuff that would pay him back within 3 years. If the answer is no to either of those two questions, then move on. Price must be substantially below conservative intrinsic value, or earnings to free cash flow must be able to pay you back within 3 years. So that's what I'm looking at. If it doesn't meet those criteria, then I am done. I spent too long. Even in a lot of my videos, I spent too long looking at stuff, spend like an hour on something only to turn around and say no. Now that can happen. That will happen, you know, it's not like that's going to stop happening, but Monish Pabrai said that you've got to say no fast within a couple minutes. So I'm hoping that will be a help for me. I'm really trying to focus now on the margin of safety. I want the decent margin of safety. I've done quite a bit of analysis with the help of AI on like early Michael Burry, Lilu, Monish Pabrai, sort of things they were looking for in their investments that got them to where they are today. And effectively, all the analysis that I've done comes back saying that it absolutely has to have a decent margin of safety, whether that comes from assets, liquidation or reproduction value, or on the earnings. Generally, most of them like no debt. You want good assets, but you can have something that is reasonably indebted, providing they're earning so much money that they can cover it. So yeah, that's what I'm looking for. I'm just trying to say no as fast as I can, just so we can move through some more stuff. So yeah, margin of safety now is the absolute thing for me. Needs to have it, otherwise it's going to have to be a no. And like I said, I've come to that conclusion from analysing Michael Burry's MSN articles, what you can find Monish Pabrai. To be fair, there's a lot of Monish Pabrai stuff out there. He is very, very giving with his knowledge. Lot of decent videos that man's put up, worth looking at, worth sitting down and watching. And yeah, like I said, there is a lot of Michael Burry stuff around, early stuff as well, which is pretty good. Lilu did a very good lecture with Bruce Greenwald, which is definitely worth a watch. Obviously all the other stuff, Benjamin Graham, Warren Buffett and all that, but everything comes down to a margin of safety. Understand the business, see how the business makes money, which you can do quite quickly because you can get any of the AI software to tell you what a business does. If you don't understand how it works, then you can tell it to talk to you like you're an idiot and break it down to you, which it would do. So within a matter of minutes you can understand the business, and then, like I said, straight to the balance sheet. What's the balance sheet giving me? If the balance sheet's giving me nothing, I have a quick look at the cash flows. If that's giving me nothing, it's goner. I'm trying to say no as fast as I can. Everything now, from now on, is going to be, does it have a margin of safety? And if so, then we will continue the analysis. If not, it's gone. So this is where we're at. And hopefully we can find some low-hanging fruit. Obviously, there's a lot of the US markets which is completely overvalued at the moment. So although this screener at the moment is currently in the US, we will probably end up, once we've gone through these 79, moving on. The only other thing I did as well is that I didn't have primary listing on the screener, so you'd get a lot of stuff that was like secondary listing. I've gone primary listing only now, just for a generally for a currency thing. I don't mind investing in stuff where the currencies is different to my own, but I didn't want to be jumping backwards and forwards from one to the other, just going down the list and then having to work out any potential currency conversions. The goal is to have it so cheap that the currency conversion doesn't matter. So yeah, that's where we're at anyway. Moving on to OneSpan Inc. Identity verification digital transaction solutions, mainly to banks, financial institutions and large enterprises. Offerings help customers secure users. Okay. Business segment, security solutions focus, identity and transaction security, factor identification. Okay, hardware authenticators, so these become a smaller part of revenue. Help protect against fraud and unauthorized access across apps users. Historically, this segment generated a majority of revenue, but the mix is shifting towards its software and subscription elements or components. E-signatures and secure digital workflows. Okay, how OneSpan makes money. Generates revenue mainly in these ways: subscription, customers pay recurring fees to use OneSpan's cloud or on-premises software. Subscription revenue has been growing steadily and is a core long-term focus. Recurring revenue provides more predictability and often higher margins than one-time sales. Oh yeah, doing it again. Subscription revenue increased significantly in recent years and now makes up a large chunk of total revenue. Software and licensing, one-time and multi-year license fees for software users. Okay, historically, secure hardware products, secure authentication devices. Okay, subscription revenue has grown quickly and forms an increasingly large part of the business. How OneSpan operates and makes money. Security solutions, what it sells, authentication and fraud prevention technology, revenue model, subscription licenses, hardware, digital agreements, e-signatures. Okay. OneSpan makes most of its money through software and subscription services that help organizations secure identities and digital transactions. Okay. All right. Well, we've all used stuff like that, haven't we, when we're logging into our banks or whatever. So, helps. Not that I completely understand the business, but it helps when you have used the sort of thing that it's talking about. Balance sheet. So, very little in terms of tangible assets. $70, what are we going to say? Maybe 100 million between cash and receivables. Inventory. So it's not really a lot there, is there? Say we got 140 million between cash and receivables, property, plant and equipment, and then you've got all of this. So you've only got like 15 million left. 37 million shares, almost 40 million shares. So nothing really on the downside protection from assets, is there? And the price, from a technical analysis point perspective, looks like it's probably heading down here somewhere. Alright, we'll drag it in the spreadsheet quickly, just to probably already know, but what was it? OSPN, is that right? Yes, OneSpan OSPN. Let's drag it in the spreadsheet, see what we can come up with. OneSpan Inc. quarterly data. Ooh. This is although it's a Roaring Kitty inspired spreadsheet, it is nowhere near as complicated as what it is. Right. $4 in book value, so half of what the current price is. Tangible book value, that is. Well, there's decent growth over the last few years in that. Gross margins got better. Revenues are slightly better and share count slightly down. Simple free cash flow margin. Only recently made a profit. Average 3 years. Net income, same. Revenues a share, $6 a share. Okay, low interest expense, is that correct? In which case there's no debt. Should have looked at that, shouldn't we? Current liabilities. Long-term deferred revenues. So no, there is no debt. Okay. Alright, well that's pretty good. Let's have a look. OSPN, let's just have a look at this stuff quickly. Advert. So people are buying. Not a lot though. Although this geezer here bought quite a bit in 600 grand's worth. Okay, we haven't looked at what the cash flows are doing yet, have we? Just sort of jumped on a tangent. What's going on? You don't want to work, do you not? Try again. Here we go. Just having a quick overview. Like Ron Kitty had this stuff in his spreadsheet. I've got no idea how to put it in mine. So he's got to be something to do with his company, and 100% his portfolio. 80 million worth of. So no one's confident in this. Outside of this geezer, let's say no one's confident. This geezer's obviously very, very confident. Possibly find out that he's a founder. I don't know. But yeah, no one else is. Which is, for me, is obviously not a good sign straight from the off. Where were we? Simple free cash flow dollars just trading at 10 times, which is not cheap enough for me. And we'll see enterprise value less than. So simple free cash flow to EV 8 times. Well, that's going to tell you that the simple free cash flow is going to pay you back in 8 years outside of the parameters that we just spoke about. So yeah, not keen. Going to be a no on this one. Just no tangible asset value. There's no downside protection for tangible assets. Like your floor is below price effectively on assets, and like I said, you are earning, but not on the time scale that I'm looking for. EBIT is a little bit better. Net cash flow is a lot worse than something else is in there. Pardon me, let's just have a quick look and see what is in that net cash. Is it purchases of investments, maybe additions to property and equipment? 12 months, this is 10k. Yeah, investments, look. Cash payout acquisition of a business. So net cash, all I've done is the operating side of it. In this is, well, I got them both on there. I will show you, but I stole this one from Roaring Kitty. So net cash here is operating minus investing minus financing, whereas this one is just operating minus investing, which is like the actual operation side of a business. So I have started to rely on this one a bit more heavily actually than the other one. This is the only one I think that Roaring Kitty had in his spreadsheet, so I did take that from him, Keith Gill. But yeah, so the reason for that is an acquisition, 40 million acquisition. But yeah, no, I don't like this. And my reasons are there's no asset floor to help you. Well, there is an asset floor, but it's way below what the price is currently. Like I said, I want 30 to 50% below that. That's something that I've taken from a lot of Michael Burry's early stuff, from Value Investors Club and MSN Money articles, which you can find. It's all out there. All this stuff is still on Value Investors Club as well. You can go back and read it. And simple free cash flow is just, it's trending in the right direction, but I don't want to buy something that's going to take me 8 years to pay for itself. So that's pass for me on this one. We're just going to move on. Probably didn't say no in a couple minutes, but we certainly didn't spend too long, did we? AMC Networks. The lows, hang on. So cable television, there could be some decent assets in this mind. Just a quick bit of technical analysis before we get into it. We have very clearly got a floor and a ceiling. We are currently on our way down to the floor. What is the margin in between? 70%. All right. That's not how I do my investing, by the way, but sometimes I do look at technical analysis as a where's it been? Where could it possibly go? I think so many people use technical analysis now that it's sort of like a self-fulfilling prophecy. Not that it's everything for me moves on fundamentals, but you know, tell me there's not a tell me there's not something to do with price here. Look at this. So that's all on the upside. Then you got it on the below side. Then you got it on the below side. Then you got it on the below side. Yeah, tell me there's nothing in technical analysis when you see that. Like I said, I think so many people use it now, sort of like a self-fulfilling prophecy. Can be. But fundamentals have to move it. But yeah, worth keeping an eye on stuff like this occasionally. So AMC, I know it's a cable operator, will ask, just explain AMC to me. Explain AMC, the cable company, to me, how it makes money, what I don't know, it consists of. Even in the UK, we've heard of AMC. I know it's something that's probably quite well traded. Yeah, there we go. Breaking Bad, Walking Dead, two huge TV shows. Comcast carries it. Traditional linear cable networks. It's not the same company as AMC Entertainment, the movie theatre chain. Okay. They're related? I'm guessing they're related. So yeah, streaming service. We got Sky over here, obviously Netflix and all that, I take it. Also produces its own content for a studio arm, AMC Studios. Owning content is important because it allows AMC to license shows internationally. For example, Walking Dead became a large multi-series franchise. When did Walking Dead, let's have a look. I want to Google this a minute. Going off topic. When did Walking Dead start? Come on. First season came out when? Are you fucking kidding me? 2010. What did AMC do in 2010 when? Can we go back? Don't go back that far. I wonder how much of this though is attributed to Walking Dead's success. Anyway, where we were. Yeah. Affiliates fees, cables and satellite providers pay AMC per subscriber monthly fee to carry its channels. If AMC charges $5.50 to $1 per subscriber, that's hundreds of millions annually. Okay, advertising revenue, sells commercial time during its shows. Yeah, pretty standard stuff. Streaming subscriptions. Yeah, content licensing. Yeah, strategic position, mid-sized media company, too small to compete head-on with global streamers, larger than niche cable networks. Recognizable brands, valuable content library. Rich TV, okay. Cable streaming content company, cable channel, streaming services, production studio, how it makes money. Okay. So. Oh, God. They're on the wrong side. Right. Last one was a 10K in February last month. Balance sheet. Billion, 1.2 billion, 4 billion in assets, 3 billion in total liabilities. Okay, long-term debt, 1.7, say 1.8 to be conservative. $500 million in cash, accounts receivable. Yeah, it's quite low on the doubtful accounts, isn't it? So they're saying they got about $1 billion in cash and accounts receivable. Not a lot in property, program rights. This is This is where it's going to become difficult though from an asset point of view, is what are these actually worth? Walking Dead. What was the other one? Walking Dead and... Oh, I can't remember what it said. Breaking Bad. A lot of people still watch that. Both of those shows, a lot of people still watch them. Current portion of program rights obligations, current portion so the current portion of long-term debt is quite small. Let's put it in the spreadsheet and have a look. AMCX. Come on, keep up. 818. Right. Drag it in. Income statement. Balance sheet. Cash flow statement. Back to here. So it's fuck all intangible book value, but that's because it's probably using the TV shows as an intangible asset. Yeah, it will be. I said this is where it gets difficult because there's a worth to them, isn't there? There's not that it's not that there's not. There's definitely a worth to them. A value, a worth, a value. Speak good English. Yeah. What that is though. Simple free cash flow margin, 10%. So it's had a couple down years, hasn't it? But 3-year average is back up to what it was historically. Flew up during COVID. Look, that's just people sat at home wanting to watch stuff. Interest coverage ratio is pretty low. I normally like it much higher than that. I mean, currently at the moment, they can't afford the interest on the simple free cash flow. Interest expense a share, $7. Wow. Is that right? Not that one. Where are we looking? Interest expense, 172 million. Wow, 172 million. How many shares have they got? 31. And again, look. 172 million divided by 31. Should be able to do it off the top of my head, but you're still not with it after the bug. 105. So why is it saying it's higher than it? I mean, that's still high. But it's not as bad as that. Is that? Let's have a look. Yeah, 12 months. Interest expense over 12 months was 172 million. What have I got it as? Where are we looking? Up here. That is not accurate, is it? It's also way out of line with what it was historically. There's something essentially not right in the data. Q4 interest expense. This one here is wrong. Gotta be. Where am I looking? 344. Hang on then. I know this is not an immediate no, but I'll find Q3, just see what the interest expense was in Q3, just so we can get the data right. And again, the same fucking thing. Interest expense, 3 months, 44,574. What's that? Got it so wrong. 44,574, 123. Right. Now you're looking at 172,353. That's right, when that is the correct figure. Just got to check the data, haven't you? You know, make sure it's correct. 172,353. Now we're in the right ballpark. Now let's go back to here. Interest coverage is a lot better now. They can afford the interest, unless revenues tank, which they have done. Look, post-COVID, they've consistently dropped 3 billion around COVID down to lost almost 1 billion in revenues. That's not good, is it? Well, almost 1 billion, 700 million. $5 in simple free cash flow though, and it's 8. So you are trading at 1.4, but 7 on the debt, and I do count the debt. You are buying a business, you are buying the debt as well. I do count the debt. What is the debt schedule? Then I don't mind investing in debt, providing the it'd be easier to get up on 10k. I find get the actual 10k up as opposed to the quick format one. Debt 2029, so you got nothing until 2029. 874. Oh fuck, that got quite a bit. You got 1 billion in 2029. Over 1 billion, easily over 1 billion. What are we saying? 1.2 billion in 2029. 3 years time. Hmm. 1.3 billion. Get it right. 1.3 billion in 3 years time. How much free cash flow did we make this year? 250 million. Ain't gonna do it. Even last year, when the free cash flow was higher, and depending on the data being accurate, we've seen that it wasn't just now. At best, simple free cash flow. Oh, they're not paying that, are they? Not paying that. Let's get them refinanced. In which case, you're going to put undue pressure on the investment. Let's have a look what insiders are doing. Pretty much just made up my mind on that. Selling. 13D member. Sold 1.2 million. If you've watched any of the Roaring Key videos, he says that don't put too much stock in people selling. People sell for any number of reasons. They buy for one, generally. You only buy because you think it's going to go up. Whether or not you're right is a different story, but nobody knows more than the insiders. So who are these? Got to be insiders, surely. Dolan. Family, is it? Does it say the network? Where's the network? AMC, there we go. Who are these Dolan chaps? There's 2 of them. Okay, Real Vision founder Charles Dolan continued to retain a controlling interest in the company. Pardon me. Okay. James Lawrence Dolan, Charles Dolan. Nobody else is interested again. Look. Nobody else. 1%. 0.2, seeing exactly the same things as what we just did, I'm guessing. Debt's going to have to be refinanced. Likely will be, because they got some assets that are worth a lot. Could they be forced to sell Walking Dead, or could they be forced to sell? You wouldn't want to be forced to sell it, would you? Breaking Bad, but almost certainly you could sell some of them and get close to covering the debt. What other programs have they got then? Just off the programs, broadcast, current, Walking Dead. They professional wrestling. They got TNA, have they? Do they own it or not? Can't imagine so. They're probably just showing it. Network AMC. Right. So they ain't really got anything, have they? Breaking Bad. Who owns Breaking Bad now then? Google it. Is Breaking Bad still by AMC? No. Sony, okay. AMC only held the rights to air and distribute the show in the US, so there's no value in that then, is there? Right, well, there's no value in Breaking Bad. Who owns The Walking Dead? AMC owns and produces The Walking Dead. Okay, so there's value in that. Breaking Bad, no. Walking Dead, yes. No way they're paying for this, so is there? Well, I say no way. Let's have a look. $500 million in cash. It is lower than what it has been historically. In line with what it was previously, though. Revenues are a lot lower. Cost of revenues significantly higher. Oh no, they're not significantly higher. They're around about the same as what they were. Yeah, 50s, the entire time 50s. So that's pretty good. If they got 3 years, say they make 250 million a year. So they could, if they spent all their cash and saved all their free cash flow, which obviously is not going to happen. Doesn't happen. Yeah, it's a no. It's a no for me for now. Keep an eye on it though, because anything is anything. Well, not anything. It's just cheap enough, and the sheer outrageous value, in Michael Burry's words, comes into play. Could be worth looking into anything. At the moment, it ain't cheap enough for me. Not cheap enough. Reasons being, book value is hard to ascertain. Asset value. Oh yes, the simple free cash flow is good, but the amount of debt is huge. The vast majority of it's coming due at exactly the same time. It's not likely that they will be able to pay it off without having to refinance. It's been cheaper as well. The refinancing risk is now closer. What have we got here? What news? Any and all exchange offer. Oh, okay. We're just talking about them. Any all of outstanding 10.25. That's a lot in it. 10.25%. Oh god, they're gonna pay more. Exchange will expire. Total consideration includes early tender premium. So, when would the new maturity be? I mean, if people agree and you can push it down the line, it was a little more palatable. We expect the new notes to be further issuance and will be addition to the 10.5 due 2032. New notes are expected to be fungible with the original 2032. Trade on the same number. Okay. So it's trying to take $1 billion, close to $1 billion, 850, oh, 9, yeah, close to $1 billion. Oh, look. Which one's that? This one here, 875 million. Then push it to here. I mean, it would help, wouldn't it? You're kicking the can down the road, but it would help. $6 years. You've been given 6 years by the banks, effectively. So the banks think you're going to be here in 6 years' time, which is good because currently your simple free cash flow is going to take you 7 to purchase the business outright, including the debt. Right. It's still no for me, but that does mean that I will keep an eye on it. I will, oh, not red. I will give it the blue tag. Put it in the keep an eye on it pile. Is anyone else saying? Sell was 8 days ago, less than that, 6 days ago. Why is it a risk of performing badly? Just because of the price performance momentum. Another reverse split possible. In line with reduced estimates, but business remains under significant financial distress. Balance sheet is heavily leveraged with over $4 billion in debt. Billion in debt. It's not what I've fucking got. Not what's on here. Only $3 billion in total liabilities. Severely devalued. Nobody's. Where is he getting the $4 billion in debt from? $4 billion in debt, but only $3 billion of total liabilities. Maybe some fat finger going on. I don't know. It is highly levered, and leverage is something that the MSN articles and the Value Investor Club stuff stayed away from. All the Michael Burry stuff. Monica McBride tries to stay away from leverage. Lee Lu will stay away from leverage. Yeah. Okay. Ooh, hang on a minute. Are we looking at the wrong fucking one? I think we're looking at the wrong one. AMCX we want. There we go. Looking at the wrong one. Good job I saw it. I'd rather look fucking stupid. I might look stupid if you've cut out before I figured it out. Future free cash flow may not cover the 1.2 billion in debt. That's what we just said without a turnaround. Legacy businesses eroding. Said that. Revenues are dropping. Simple bull case. Extraordinarily cheap. Trading at 1.7 times free cash flow. Yeah, I got 1.4, but yeah, close enough. You just got to be in the same ballpark. This was at 9 at the time. Did he say sell? And a net debt of 1.24 billion. These questions: can this business in the future possibly generate that amount of cumulative free cash flow? That's why I said probably not. Guidance Q4, but they are kicking the can down the road, which is obviously post this article. AMC has done a good job in streaming. In fact, the company nicely beat the 5-year targets. Yeah, there you go. Content licensing revenue keeps falling because AMC's one owned hit gets less valuable each year, and the company hasn't found anything similar to replace it. Yeah, that's what I said, wasn't it? They don't own Breaking Bad, which I initially wrongly thought that they did. Is streaming enough? But anyway, I think we're just wasting time on this now. Take over Target, interesting. It simply looked like a business in the midst of a long-term decline, and given the balance sheet is getting heavily leveraged based on 2025 net leverage is creeping up to 3 times. This probably exceeds that in 2026. That's a huge problem. Mr. Warner Brothers drama and bidding war about Netflix, Paramount. Perhaps case at AMC could be a takeover target. Interesting. I mean, there's been absolutely no rumour of that I've heard anyway. Over optimistic The Walking Dead could be a Star Wars like franchise. Any comments? Deleveraging to their credit, they have done some smart stuff. The open market purchases of their debt. Have they been reducing debt for some time? Let's have a look at the balance sheet before we move on. Yes, they have. 3.2, so for a number of years now. Got rid of almost half of it. Anyway, moving on. I stuck a blue tag. Oh, bugger off. Stuck a blue tag on it, didn't I? And then we move on. Doing this an hour already. Emerging Market Income Fund, not interested. Not enough data in this. May engage in providing comprehensive business solutions, not interested. Hog, Harley Davidson. Interesting. $18 a share. Interesting. Yes, I'm sure I've done a video. No, I haven't. Definitely done a video on Criteo. Long time ago now. Hog. Anyway. I don't need to, well, see what business segments there is, but I don't need to look into Harley Davidson. I ride motorcycles. I know what Harley Davidson is. Interactive data. Financial statements, operations, motorcycle, financial services. Okay. Drop in though, look. Drop significantly. Motorcycles are very much like clothing. They're in, you know, in flavor of the month, and they're not. 3 billion in cash. That's pretty damn good. Total long-term debt 1.6. Current portion of long-term debt 800. Property, plant equipment. So we got 3 billion in cash, right? Accounts receivable 225 million. I don't know what you're going to say for that. Held for sale. Take it they sell off that to somebody else today. Held for investment. Right. What I want to do here. Explain how the finance arm of Harley Davidson works. The balance sheet shows finance receivables held for sale and finance receivables held for investment. Explain. Investment. In-house bank. Finances motorcycles for customers. Yeah. Originate loans. 2 buckets on the balance sheet. Right. HFI. Investment. These loans Harley intends to keep on its books and collect over time. Earns interest over the life of the loan. Okay, yeah. Okay. So these loans are just sell for third parties. Why do this? Frees up capital, reduces balance sheet risk, improves liquidity. So what you're going to have to do then, how it all fits together. Okay, so it helps fund more loans. Need to find out what the non-performing loan side of it is, and let's put Harley Davidson into the spreadsheet. I was looking at Harley, but I ended up going for the Triumph Bonneville Bobber instead. I quite like the 48 in the Iron 883, but said went for the Triumph instead. I just think it's a better looking bike, and not only that, it's a soft tail that looks like a hard tail, so you still get the suspension. Right, $27 in book value, so we're, you know, tangible book value in there, aren't we? Probably could do with it being a bit lower, to be honest. $4 in simple free cash flow. Historic average. What have we got there? 9 years. Let's do this one. 10 years. Average of $4 so we're below the 10-year average. Net cash. Why is that so high? What have they done there then? Is investment activities there? So finance receivables initially held for investment. So they fucked a load of them off. They weren't intending to. It's a huge drop. In net income. capital expenditures there. 400 million. What's the debt again? Long-term debt. Oh, fuck off. Got there in the end. Short-term debt, 500 million. Long-term debt, 2.1 billion in debt, which is covered by the cash. I'm guessing the cash has grown significantly because of the sale of financing, though. When does the debt come due? Let's have a look. I don't know that it's cheap enough, but it's looking pretty cheap, isn't it? We are in the COVID lows. Debt. Here we go. June 2026, 800 million. They can afford that. They can afford. They can afford all of it with the current cash they got on the books. So the balance sheet is pretty good. Long-term net debt 1.6. Current portion of long-term debt that's paying this year, which they can afford to do. Right. Simple free cash flow. 415. Maintain a neutral price target from the stock from 27 down to 19. Shock. Honestly, I swear when you read some of these things, it's just like, oh, the price is there, so we'll put our estimate there. What's anyone else saying about Harley Davidson? Wrong one, what am I doing? Come on, up here. Oh. So we're cheap on assets. Badly momentum again. Long-term growth. Okay. Hold strong buy. Extremely undervalued. Faces secular decline, Asian demographics, and market share losses. Unlocks 1.25 in discretionary cash. Reduces capital requirements and strengthens Hulk's balance sheet. Okay, so did that cash come from somewhere else then, did it? Despite a 35% revenue decline, Hulk remains profitable, which it does, and protecting margins through deleverage and cost cutting. Net tangible value per share near $19 and the stock at 20. Years limited. What have I got tangible book? I got it at 27. And they've got 19. Is the data correct again? I guess. Depends how they've. 8 billion in assets. So, what have we got tangible? Held for investment. It's different then. 5.5, 8 billion. Oh, I've got no intangibles here. And no property, plant, and equipment. Which is clearly not correct. Sort that out a minute, just drag the thing off screen. Oh, they're saying they got no intangibles. Got some goodwill, which I've got on here. Property, plant, and equipment. 750,224. Right. Read the article and see where he's getting his. Current long-term liability is 2658. Yeah. Okay, the rest looks correct. Read his article and see where he's getting his tangible book value from. I would much rather use a more conservative one, that's for sure. If it's at 19, it's not low enough yet for me. Secular decline, yeah. There's a bit of a growth in Europe. Even though the company stopped reporting the average age of its customers, it's clear that the brand appeals more to older motorcycle riders as it has a rougher image. It's full of nostalgia and is considered a luxury item due to its price. They are expensive. Although I think most motorbikes are expensive now. Widely reported and is also easily visible when we cover the financials later in this article. What we see, you can see it, can't you, in the revenues. I mean, they're not hugely declined, but they have declined. Debt deal. Announced a strategic partnership with KKR. Sales last year. The deal includes a sale of a stake in 9.8 Hogs Financing Company. Two partners, acquisition of 5 billion in loan receivables at a premium to par, and agrees to sell around 2/3 of future loan receivables to the two companies. Okay. This deal allows Hog to operate as a much leaner company, greatly reduce capital requirements, and unlocks 1.25 in discretionary cash. As can be seen in the chart above, the deal was well received by the market. 2025. Here, maybe. Using TradingView as well, I think. Is it TradingView? No, it's not TradingView. 25% in a month following the announcement. Following the increase in share price, Hog's short interest also saw a major increase, reaching a short interest of over 14%. This means that from the time of the announcement, short sellers increased their net short position on the stock by over 50%. The stock has now given up all gains from the debt deal announcement, currently trading at multi-year low of less than $20 per share. The declining share price appears to be a result of short sellers doubling down and general anxiety around this declining company. Right. I never really understood how short sellers can lower the price of a company. Like, Warren Buffett has effectively always said that it doesn't mean nothing other than the image, I guess. Not something I've ever been bothered by. Looking at the company's financials follows the common thread of decline. Revenue declines. 2026 represented a decline of 35% in just 3 years. Also expected to decline yet, obviously. Oh, no surprise. There we go. Adjusted tangible assets. Here we go. $18 a share. Hog's fair value has a strong balance sheet. It does have a strong balance sheet. The company enjoys following the debt deal since some of the partners executed Q4 does not yet reflect the total impact. To make the value of Hog's assets clear, we will, based on the Q3 2025 release, adjust the company's balance sheet, ignoring it. So it's Q3 when this is a 10k in it. So this is wrong. Ignoring the intangibles, leases, taxes, and property. So it's got rid of the property. That's interesting. Only leaves tangible assets in the form of current assets and loan receivables. Why would you not put the property in? Okay. So he's using assets that can and will be converted into cash. Okay. Alright, I see where you're coming from. The idea that the property's not worth anything, though. I get what he's doing. $15 per share. This means the current price for the ongoing business is only valued at $5 per share. What's he talking about? Keeping our adjusted net tangible assets from the above, and we value the company based on enterprise value earnings, enterprise value free cash flow, almost 10% in equity now owned by strategic partners, more liquid nature of around 600 million long-term receivables. We discount our adjusted net tangible asset number by 20% to be overly conservative. Discount results in a value of $15 per share. This means that current price is around $20 per share. The ongoing business is only valued at $5 a share. Okay. We believe the market is currently completely missing the mark about Hogg's assets and is massively undervaluing the stock as a result. Just an enterprise value of just 600 million. Earnings per share 2 trades at an EV of less than 2.5 with an expected 400 million. EV free cash flow of 5. Adjusted EV of the company would be 2 billion based on the 2026 estimate, adding $15 per share in asset value on the balance sheet. This results in a valuation of over $30 per share. With large buybacks planned, extremely high short interest, we believe short-term potential could be even higher than that, triggered by large-scale short covering. So a bit of short squeeze as well. Any comments? Hog or dog? Another loss-making quarter in the books where you could buy a great American brand. I don't think it's going anywhere. The balance sheet's too good. Doesn't seem like you visited too many dealerships. All hog problems are self-inflicted. Worst thing for investor. Japanese and Indian bike makers are eating their lunch. They're not very reliable, I will say. The perception is that Harley Davidson are not reliable at all. No, it's where it should be. Harley is junk. It's interesting. No one writes articles, goes and talks to dealers. Saw everything. How many times does this, as we said, Gen X drives less than boomers, millennials ride less than Gen X, and Gen Z rides least of all. Nothing has changed since. You want to trade a hog, great, have it for temporary bounce, long-term buy, forget it. In 10 years, one or two things will happen, or maybe both. The company gets near or is near bankruptcy and is bought out by private equity. Dying brand, it continues to die. I mean, you can't argue with that, can you? The younger generations are not outdoorsy. As long as the decline is managed well, dying brand can still be profitable to shareholders. I do agree with that. GameStop. Have tariffs hurt Harley Davidson stock price? You'll get your answer. They break it down. The company was in decline long before tariff impact. Should have about $14 of cash net of debt. Finance subsidiary worth about $4 a share. So you're getting the motorcycle business for virtually nothing, despite significant tangible assets, overfunded pension plan, of course, the iconic brand. Okay, but the problems are very real indeed. $14 of cash net of debt. Have a look. $27 of cash. Cash minus debt. Not what I got. I got 33 cents. I got it right. Have a look. Total debt 3 billion. Cash 3 billion. Yeah. Interest coverage though, 12. That's really good. Anything above 3, I think, is amazing generally. Finance subsidiary worth about $4 a share based upon the KKR purchase price. Explain what happened with KKR. Majority stake in this funding, so I'll leave it for 50%. How much did they pay for it? That's what I want to know. Okay, right, come on. How much did KKR pay? $1.8 billion to $2 billion. Based on the KKR position, what would the total value of the finance arm be? Got a 4.9% equity stake transaction implied. $8 billion. How many was the share count? Right. It's just getting late now. My brain's not bloody working. $4. Finance subsidiary worth about $4 based upon the KKR purchase price. So again, team's oversold. It's all about tariff policy. Office management made investments. I don't know where this cash has come from though. $14 of cash net of debt. I ain't seeing that. $3 billion in cash. Short-term debt of $500 million, $2 billion. So you got $1 billion. Okay. Why? So my data's wrong again. We're really saying it's wrong again. It's like the fucking free for free, and it looked at free companies. Right, short-term debt. Why have I got 1.3 billion? Current portion of long-term debt. 819. 819. 629 123. Right. Long-term debt is what? Right. So just add this up and change my total debt. Smashing one of my guitars. 819 629 plus 2538. So that is wrong. 2538. Right, now let's have a look. Cash minus debt $4 a share. Ain't got the fucking 14 that he's got. Am I missing something? Like I said, it is almost 1 a.m. now, so my brain is not functioning at its peak capacity. I say $4 and he's saying 14. It makes no sense. What was it? They hadn't had the Q4 out at the time, had they? Problem is, they don't spread out the debt. You just lump it all in. Like leases and all that be in here as well, which is a bit fucking annoying. That's why you've had this huge drop, look, because you've got leases and all that in there, whereas I don't tend to count them. Not got the 14 that they've got, but finance subsidiary worth about $4 a share based on the KKR purchase price. Does he talk about KKR? Didn't he? What's he saying? Debt deal. Sale of a stake of 9.8% to two partners. KKR is selling over $5 billion in loan receivables at a premium to par. .9% equity stake. The transaction implied about 1.8 billion. Did they pay 88 million? What did they pay? What's the other one? Something or other. .9% equity each, an implied value of 1.8 billion. Okay, so you are saying they did 88 million, so 1.8 billion. Implied equity investment of 176 million. That's just for the equity stake. So 1.8 billion. Let's see what it's worth a share. 1800 divided by, was it 114, wasn't it? $15 a share. Oh, my brain ain't fucking working. We'll have to come back to this. There's no way the finance arms were $15 a share. Anyone else talking about it? As my brain's not fucking working, we definitely have to come back to this. Notes, latest news. Dividend at 4%. I didn't even notice it had a dividend. 76. Okay, almost $1. Right. I'm gonna fucking come back to this and try and have a look into it deeper. That maybe on the verge of junk status. Really? Even though they can pay it. Oh, fuck it. I'm opening other shit now. Market cap of 2 billion. They're saying that the equity value of the finance arm is what, 1.8. So for 400 million you're getting the bike arm. We'll have to sit down and separate out the income from each. That's what we'll have to do. I said I just don't know where he's getting his $14 value from. I'm off it now, aren't I? I have to read the next one up as well. Right. We'll finish the video here. There's been a lot of fucking waffle at the end of this one. We'll continue with Harley Davidson in the next one. I want to try and understand these figures because I'm not seeing $14 of cash net of debt. By my calculations, Hog should have $14 of cash net of debt. I don't see it. What am I fucking missing? Short-term debt, long-term debt, 2.1, 3 billion in cash, 900 million. What was it? 900 divided by 114.3. $8. Half of what he fucking said. Alright. Well, fucking ChatGPT is dropping off again as well. Look. Alright. We'll end this video here and I will come back to Harley Davidson. We'll try and break it down a bit more because I mean, where's the all-time low? Way down here. Way down here. In the 80s. In recent times, what's that? Credit crunch. COVID. We're almost near the COVID lows. Alright. Alright. See you on the next one. We'll continue with Harley Davidson because my brain's just not fucking working now. It's too late in the day. We will continue with Harley Davidson on the next one. So thank you very much. Like and subscribe. And sorry that the last half an hour of this has just been utter shite, but it is what it is. Alright, cheers, thank you. Bye-bye.